Hello everyone, it's Billy Abrams, CEO of ADM Securities, and myself, Alex Suslov, Head of Capital Markets at AD Mortgage, here with you for our AD Weekly Digest.
Hello everybody, hello Alex.
Hello Billy. It's been a great weekend. I hope you had some rest and enjoyed your time over the weekend, saw some fireworks.
Fireworks and barbecue, that's the deal.
Perfect. Last week we had an ECB meeting, and I'd say the main focus was on the inflation, and heads of central banks has indicated they are aimed at tackling inflation no matter what, and also the indications were that the recession is possible.
Right.
This is what traders are betting on today, and that's why we see better rates, as I understand. Spain inflation was a little high last week at 10%, even though PCE numbers went out better, 4.7 versus expected 4.8. So we see consumers demand softening a little bit, which brings us a little more confidence, and possibly Fed reversing its direction with the rate hikes. But again, just to remind everyone, as Fed has indicated during their last meeting, they want to see at least 3 months of a declines in the PCE and CPI numbers. And also one more factor, the Federal Reserve regional gauges are showing weaker June activity today, which is supported by PCE. Freddie Mac 30-year fixed rates went down from 5.8% to 5.7%, so it's 10 basis points reduction. Okay. Non-QM has also 10 basis point reduction from 7.7 to 7.6 today, and ARM loans are at 4.5% today. What do you see on the market as far as treasuries rates and where we're headed?
Well, Alex, it's actually been a fun couple of weeks for a technician, which is what I like to do. Right before the Fed meetings, we posted the high yields that we've seen in years, in 360 or something like that in the 5-year. And back then they were betting on, the market seemed to have discounted nothing but the Fed tightening into next year. Now, as you said, Powell's mentioned the word recession as something that we have to concern ourselves with, and lower jobs numbers. And so suddenly now the market is discounting the possibility that everything doesn't go exactly the way it's planned, which it seems to never do that anyway. So the markets are now in a rally mode, and it's interesting how we got here. Technically, as the market started to rally, I think it was on the 22nd of the month, the markets had nice bullish gaps, which means they opened one day at a much lower yield than they traded at the previous day. I view those as always very important technical features. A day later, they hit the low yields. The 5 and the 10-year were both in the low 3%. And they, if anyone looks at my updates that's watching this, they probably read this, and I had some charts posted. But they both hit trend lines that were drawn off the March 1st low yields. And the reason I had trend lines on my charts from March 1st is because that's where the acceleration up in yields began. And both the 5s and 10s hit those trend lines. They immediately backed away, and they traded right up into the gaps that were left 2 days earlier. And I had written down a couple times, and I always thought if those gaps got filled, the markets were probably going to get heavier, and if they didn't, we could see a better rally. And sure enough, both gaps were tested, neither one was filled. And a day later is when Powell made his comments that mentioned recession. And a day after that, the 10-year is back under 3%. So I think we're in a corrective rally. I think we're going to see at least the mid 280s during this rally, 5s and 10s both. I wouldn't rule out the low 270s, but cart in front of the horse. But I think there's a little bit more room for the markets to rally, technically speaking. The stock market's been looking pretty heavy and still does, and that could contribute. Crude oil market has backed up again. It's pretty volatile, but it's trading closer to 100 than it is 120 where it got to. So I think there's good news in the markets, and technically I think it can continue. I think the rallies are going to be choppy, but I think they can persist.
Absolutely, can't agree more. And we see the same on the non-QM market as well. Investors are being cautious, and it's very hard today to price to the duration of bonds, because depending on the rates that may extend, which is a risk for investors. Among other non-QM news and mortgage news, I'd like to recommend an article in a new Scotsman Guide release. The article posted is written by our team, with Max heading the team. It's on the tech developments of mortgage lenders that are of paramount importance in these days with the margin compression. We're looking also to host a webinar on July 5th on the millennial home buyers and the possibilities of millennials getting a new home or an investment home. And on July 12th, we'll be hosting a Q&A session with our broker support on our new LOS system, where our team will be answering all the questions and helping out our partners.
Excellent. And I think coming up next week, or during the next week before we sit down again, economic calendar's kind of light. There's a couple of auctions, 10 and 30-year auctions. There's some PCE and ISM numbers. And there's minutes to the last FOMC meeting. May or may not be important. It'll be interesting to see what they talked about and who voted where. But other than that, it's going to be a rather news-quiet week, and we'll see where the markets can go.
Perfect. Look forward to it. Thank you, everyone. It was Billy Abrams, CEO of ADM Securities, and myself, Alex Suslov, Head of Capital Markets at AD Mortgage. Stay tuned.
Thank you.